325 million subscribers, $9.5 billion in free cash flow, and an advertising business about to double in a single year. Today we're diving deep into Netflix, the company that invented modern streaming and is now rewriting the playbook on how to monetize it.
And the timing is perfect, Hudson. Netflix reports Q1 earnings in just 8 days. Goldman Sachs just slapped a buy rating on the stock, and shares are sitting 26% below the 52-week high. There's a real tension between the bears calling this a maturing growth story and the bulls who say the ad business changes everything.
Let's settle it with the data. Netflix, ticker NFLX, is headquartered in Los Gatos, California. Founded back in 1997 by Reed Hastings and Mark Randolph, the company started as a DVD by mail service. The legendary origin story involves mailing a CD to test whether discs could survive the postal system. 29 years later, Netflix is the world's dominant streaming platform with over 325 million paid subscribers across 190 countries.
The business model has evolved considerably. The core is still subscription streaming. That's about 97% of revenue. But the advertising tier, launched in late 2022, has emerged as the fastest-growing segment. Ad revenue hit $1.5 billion in 2025 and is expected to double to $3 billion this year. Then you have the emerging verticals, gaming, where they're building cloud-based titles, playable on TVs using smartphones as controllers, and live events like NFL games and WWE programming.
What makes Netflix special right now is that they're the only profitable pure-play streaming company. Disney Plus, Peacock, Paramount Plus, they're all still trying to figure out how to stop bleeding money. Netflix is doing 30% operating margins and generating almost $10 billion a year in free cash flow. That's not a streaming company. That's a media empire with software economics.
The competitive moat is substantial. Netflix spends $20 billion a year on content, more than any other streamer, and targets 90% original or exclusive titles in its U.S. catalog. That creates a self-reinforcing flywheel. More content drives more subscribers fund more content, and the per-user cost of content decreases as the base grows. Add in the first-mover advantage in international markets, the brand recognition, and the data-driven recommendation engine, and you have a business that's genuinely difficult to replicate.
The why now is compelling. Netflix reports Q1 on April 16th, just over a week from today. Goldman Sachs recently upgraded the stock to buy with a 120 price target. The ad business is hitting its inflection point with 190 million monthly active viewers on the ad tier. And the stock at $99 sits in the lower third of its 52-week range, which runs from 75 to 134. The leadership story at Netflix went through a transition in early 2023 when Reed Hastings moved to executive chairman and handed the CEO role to two people, Ted Sarandos and Greg Peters.
Sarandos is the content visionary. He joined Netflix back in 2000, became co-CEO in 2020, and he's the person who convinced the company to make the leap into original programming. House of Cards, Stranger Things, Squid Game, that entire strategy traces back to Sarandos. His background is actually in the video rental business. He worked at a store in Arizona before joining Netflix.
Peters is the operational and product side. He joined in 2008, became co-CEO in January 2023, and he's the architect behind the ad tier launch. He studied physics and astronomy at Yale, which tells you something about how he approaches problems. Very data-driven, very systematic.
Wall Street has been impressed with the pairing. Under their joint leadership, Netflix has nearly tripled operating margins from about 10% to 30% while maintaining subscriber growth. The discipline around profitability, slowing content cost growth relative to revenue, launching advertising, implementing the password-sharing crackdown, that's all happened under this co-CEO structure. Let's dig into the financials. Netflix trades at about $99 with a trailing PE of 39 and a forward PE of 31.5. That's a premium to the broader market, but it's come down significantly from the 60-plus PE ratios we saw a couple of years ago.
Price to sales is around 9.3, and the PEG ratio sits at 1.5, suggesting the stock is reasonably valued relative to its growth rate.
Revenue has been growing consistently. Q1 of 2025 came in at $10.5 billion, up 13%. Q2 was $11.1 billion, up 16%. Q3 hit $11.5 billion, up 15%, and Q4 finished at $12.1 billion, up 18%, the strongest quarter. Full year 2025 was $45.2 billion, up nearly 16%.
For 2026, management is guiding to roughly $51 billion in revenue. That's 12 to 14% growth. Slower than 2025, but still healthy for a company generating this much cash.
Margins are the real story. Gross margins sit at 51%. Operating margins reached 29.5% in 2025, and the company is targeting 31.5% for 2026, a 200 basis point expansion. Net margins are 24.3%. Earnings per share came in at $2.53 trailing, with forward estimates around $3.14.
Cash flow is where Netflix really shines.
Absolutely. Operating cash flow was $10.2 billion in 2025. Capital expenditures were just $688 million. This is an asset-light model. That leaves free cash flow at $9.5 billion, up 37% year over year. Free cash flow margin is nearly 21%, which is exceptional for a media and entertainment company.
And the balance sheet?
$9 billion in cash against $14.5 billion in total debt, giving a debt-to-equity ratio of just 0.51. Current ratio of 1.19. Return on equity is 41%. Return on assets nearly 20%. Overall, Netflix's financial health is strong and accelerating. This is a company generating substantial and growing cash flows with expanding margins, a conservative balance sheet, and the financial flexibility to pursue both M&A and shareholder returns simultaneously.
Analyst sentiment on Netflix is firmly bullish. 45 analysts cover the stock, 37 rate it buy, 7 at hold, and just 1 sell. The average price target is around 120, implying about 21% upside.
The range is wide, 77 on the low end, 152 on the high. Goldman Sachs was the headline recently, upgrading from neutral to buy and setting a 120 target based on margin expansion and earnings acceleration. Wells Fargo sees 25 to 30 times earnings as fair value. Jefferies remains bullish on ad monetization.
The most recent earnings in January were solid. Q4 revenue came in at $12.1 billion, beating the 11.97 consensus by about 1%. Earnings per share were 56 cents versus 55 expected. The Christmas Day NFL games drew a record 27.5 million viewers.
But the Q1 guide was a bit soft. They guided earnings at 76 cents versus the 81 cents the street was expecting, and revenue at $12.16 billion versus $12.19. So there's a gap between quarterly guidance and the bigger picture story of margin expansion and ad revenue growth. The April 16th report should help clarify whether Q1 was genuinely lighter or just conservative guidance from management.
The bull case starts with the advertising business. Netflix launched its ad tier in late 2022, and it's taken off faster than most expected. Ad revenue hit $1.5 billion last year, and management expects it to double to $3 billion in 2026. 40% of new signups are choosing the ad-supported plan. With 190 million monthly active ad viewers, Netflix has built a massive audience that advertisers want to reach, especially with AI-powered pause ads and interactive formats rolling out this year.
The bear case starts with growth deceleration. Revenue growth is slowing from 16% in 2025 to 12 to 14% this year. North America and Western Europe are approaching saturation. When your subscriber base is already 325 million, the math of growing gets harder every quarter.
Second bull point. Live sports and events are creating an entirely new monetization vertical. The NFL Christmas Day games proved Netflix can do appointment viewing at scale. NBA and Olympics coverage are planned for expansion. Sports viewers generate 3 to 5 times higher ad revenue per viewer compared to standard content. That's a premium no competitor can easily match with on-demand catalogs alone.
Second bear concern, competition is intensifying, not easing. Apple, Amazon, Disney, and NBC are all spending aggressively on content and sports rights. NBC alone is putting $8 billion into sports rights this year. Bundling strategies from competitors like Prime Video with Amazon Shopping or ESPN Plus with Disney Plus pressure Netflix's standalone pricing power.
Third bull, operating leverage. Netflix can raise prices 15 to 30% without meaningful churn because the service has become essential entertainment infrastructure for most households. Content costs are growing slower than revenue, margins are expanding, and the free cash flow machine funds everything.
Third bear. Content cost inflation is real, especially in sports. The NFL, WWE, and NBA deals are multi-billion-dollar commitments. If content costs accelerate faster than ad revenue scales, the margin expansion story gets compressed. And there's a question of whether the ad tier cannibalizes higher margin standard subscriptions. 40% of new signups choosing ads means 40% fewer people paying full price.
Let's benchmark Netflix against its peers. We're comparing to Disney, Amazon, and Warner Bros. Discovery.
On valuation, Netflix trades at 39 times trailing earnings. Disney is at 20, Amazon at 28, and Warner Bros. Discovery at just 8. Netflix carries the clear premium, but it also has the best margin profile by a wide margin, no pun intended.
Revenue growth shows Netflix at 14% for 2026, compared to Amazon at 11, Disney at 9, and WBD at 6. Netflix is growing fastest among pure entertainment companies.
Operating margins really tell the story. Netflix is targeting 31.5%. Disney's streaming segment is around 17%. Amazon's entertainment margins are roughly 9%. WBD is at 12 and declining through restructuring. Netflix is the only streaming company with the profitability to fund content investment purely from operating cash flow.
What's the options market telling us heading into earnings?
The put-to-call ratio sits at 0.85, slightly bullish but mostly neutral. Implied volatility is at 46%, which is above the 52-week median and pricing in a 5 to 7% move around earnings. Open interest clusters on the call side around 105, 110, and 120. On the put side, concentrations sit at 90, 85, and 80.
So the market expects a move, but isn't strongly positioned in either direction.
Exactly. The open interest percentile is actually pretty low at 18%, which suggests that most investors are waiting for the earnings data before making big bets. If there's a surprise, in either direction, the resulting move could be amplified by the relatively low positioning heading in.
Insider activity at Netflix follows a familiar pattern for a company at this stage.
Over the past 90 days, insiders have sold about $287 million worth of shares, with zero buys. Reed Hastings exercised and sold $40 million in shares in early April. Chief Legal Officer David Hyman sold about $2 million in January, all under pre-planned 10b5-1 trading plans.
No buys at all, even with the stock 26% off the highs.
No, and while that's mildly bearish in isolation, it's consistent with patterns at companies where executive compensation is heavily stock-based. These are diversification and tax planning sales, not conviction signals. Still, investors paying attention to insider sentiment will note the absence of anyone stepping in to buy at current levels.
Key risks to track. First is the April 16th earnings. Management guided light on both EPS and revenue for Q1, so any miss could trigger a sharp sell-off in a stock that's already down significantly.
Second is ad tier execution. The proprietary ad tech stack is still maturing, and if advertiser ROI disappoints or technical issues emerge, the $3 billion target gets harder to hit. Third, price hikes planned for Q2 could drive unexpected churn in mature markets. Fourth, content costs. Sports rights inflation is structural and could compress margins if ad revenue doesn't scale fast enough.
The key metric to watch going forward is advertising revenue per user. As Netflix scales the ad tier from 190 million viewers, the question is how quickly they can improve monetization rates per impression. That number tells you whether the ad business is truly transformative or just incremental. Here's where we net out on Netflix. This is the undisputed streaming leader with 325 million subscribers, expanding margins, and nearly $10 billion in free cash flow. The ad business is at an inflection point. Live sports are creating premium inventory, and the stock sits well below its highs.
But growth is decelerating, competition is intensifying, and the valuation at 39 times earnings still prices in significant execution. The verdict is strong and accelerating. The profitability transformation is real, the cash flow generation is impressive, and the ad business opens an entirely new growth vector. At $99, Netflix looks attractively priced if the margin expansion thesis plays out. The April 16th earnings report is the next major proof point.
The single metric to watch is operating margin trajectory. If Netflix hits or exceeds the 31.5% target while growing revenue double digits, the bull thesis is firmly intact. Let me close with a quote from Netflix co-CEO Greg Peters. He said, "We're just about 7% of the addressable market in terms of consumer and ad spend, so tons of room ahead of us."
That framing is important. Even at 325 million subscribers, Netflix sees itself as early innings. Whether you agree with that assessment depends on your view of pricing power, international growth, and ad monetization, but the ambition is undeniable.
That's going to do it for episode 71 of Charged Alpha, Netflix, ticker NFLX. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.